Hi, and welcome to another episode of Nursing Your Way to Wealth, where a mental health nurse and an accountant talk about wealth creation, personal development, and financial independence in the UK to help you live the life you deserve. Hello, and welcome back. This is episode 57. We've titled this one Asset Allocation. And for that, I have accountant Alex here as well, who's going to help me out with it. And we're just going to talk a bit about what the term actually means, because it's quite broad. We'll talk about different types of assets, how you can use them to be part of your portfolio, the stages of life. You could perhaps consider those in as well. But before we dive into that, I've been listening back to some of our old episodes, and I've uncovered something called return on heartbeats that we just dipped into one episode in December, which is an idea that Alex had of things we've done this week that are a good return on the heartbeats that we have in life. So I've been thinking about that, and I've got a stack of like finance books sitting at home here, and my wife's always telling me, please, if you've read them, you're not going to read them again. Give them away, do something with it. And I've been of this opinion that I will read them again for reference, and they've been under my bed for about a year, and I've done nothing with them. So I've decided just to post them out to people. So I just put a post on Reddit under one of the books. Someone mentioned the Smarter Investing book by Tim Hale. And I said, look, I'm in the UK. I have a copy of this. If anyone here who wants it to read it, just message me and I'll post it out. And I've done that for 3 different books. So on Saturday, I'm going to post 3 books out to 3 different people with the idea that they read it, add their name to the list that I've created in the book itself of like Redditors who have read this book, and then post it on to someone else. So I thought that was quite a useful idea to spread knowledge.
I really like that idea. I like yeah, putting your name in there as the register. A bit like
That's
the
it.
old library books, isn't it?
Yeah, add your name, pass it on,
Yeah,
and post it out because obviously I'll just post them out for free to these people with the idea that they continue the pattern.
that is. Yeah, I like that. I think that's really nice.
And I hope one day someone else gets it and it's got like 10 names and dates in the book and it goes all the way back and one book has then empowered 10 people or more. Hopefully we run out of space on the page or something. So yeah, that was my original return on heartbeats. That was your original idea.
Yeah, well, I think that's a yeah brilliant example, and yeah, agree.
Yeah. Okay. So I'll pass to you for just some info thoughts on asset allocation, and I'll just kind of dip in and help out a little bit, but this is much more your bag than mine.
Yes,
And then we'll do, I've got a great, reasonable, or ridiculous for you, and then we'll do a quick summary at the end.
yeah, perfect. I can go on to asset allocation, and so I guess it's one of those things which you might often hear about, and certainly if you've been reading any of the kind of finance books or investment and portfolio management books, it's a bit of a key term. And so I guess the session today is really just to talk through a little bit about what that means in practice, what are some of the assets that are kind of you can include in those, and what might work. So I guess before we dive into it, in terms of what are the assets that it talks about, and I think we've covered these in some of the previous episodes, but your big asset classes are things like your equities or your stocks, you've got bonds, you've got cash, commodities or gold, um, and some property as well would be another one. And that property can come in the form of, we talk about it here, is probably less about your own personal residence, maybe some buy-to-let property, but when I talk about it, it's mainly like real estate investment trusts. So these are property companies that you can buy the shares in. So they're still an equity, but they're a very specific type of property equity. Now, and then I guess within each of those asset classes, you've got um, various different equities from different countries, but different industries that those are in, uh, big companies, small companies. So there's a huge range and depth within those asset classes. But what's the important thing is, so asset allocation is about choosing the right percentage of each of those assets to include in your portfolio to give, and then that's step one. And then step two is then diversifying within those asset classes themselves. And there is the thing with asset allocation, there is I guess, the theoretical model where you can come up with what the perfect allocation would be given known returns and known kind of standard deviation or risk. But in practice, there isn't a perfect asset allocation. You only would ever know in hindsight. And kind of our job isn't to create perfection. It's about having an appropriate portfolio for your stage in life and your investment objectives. So I think trying to find the absolute pinnacle perfect portfolio just is out of reach. Nobody can do it. So I think we can get knock that one on the head as a one, but it's about trying to build what is an appropriate asset allocation for your point in time. And the way to look at them, and I'll talk through some sample portfolios of what some might look like. And you've got at one end, you've got really aggressive, so it's your time where you want your money to grow, and you'll tend to have a few more equity, have more equity exposure. So you want to have more of your equities in a portfolio. And the reason being is they, over the long term, albeit being very volatile as we're experiencing at the minute, they tend to produce the highest returns and beat inflation over a long period of time. So when you've got a long time horizon ahead of you, so if you're just started investing, you're like just starting your career, and you've got 10, 15, 20, 30, 40 years ahead of you, because you don't need that money yet, you can just let that money run. And so you want more equity. Bonds get into play when the bonds pay out um, fixed income based off the coupon that's on the bond. And these are a lot less volatile in terms of the price doesn't go up or down as much as equities, but conversely, you don't get as much return. And then there are other asset classes which are a bit more, they're sometimes called like alternatives. And you tend to not want too many of these in a portfolio, but these are just another form of diversification. So commodities are good when you want to try and beat inflation. So commodities, so inflation as a kind of concept within an economy is the rising prices, and a factor in those rising prices is the input costs for a lot of businesses, and a lot of those input costs are things such as the raw materials that you would use, whether that be food, whether that be energy, whether that be coal, I don't know, that type of thing. So commodities, getting some exposure to that will help offset a bit of inflation. And also things like within commodities like precious metals and like gold is a perfect example where there is turbulence in markets. Gold, you'll often see the gold price rise. And as we're seeing today, I think it just hit a new high today actually. People tend to flock to gold as a kind of safe haven. So it can be a good idea to have a small amount of exposure to gold in your portfolio. And then, yeah, property as well is just another diversifier. And that within that, you can have like residential property, you can have office buildings, shopping centers, like more like commercial property, even things such as care homes. You can get share property companies that invest purely in those things. And it's just another part of it's just diversifying away some of the risk from having pure equities. So those are kind of the asset classes and how you might want them. The if you're looking to it's early on in your career and you've got loads of time to invest, a common portfolio for people that kind of doing like the fire path is 100% equity exposure. That's an incredibly volatile journey in terms of that you'll find because equity prices move around a lot, but you get better returns. But you could also put in there rather than 100% equity, maybe have 90% equity and 10% bonds could be an example. Or 80-20 is a very popular kind of balanced portfolio, or maybe 15%. So you have 85% equity, 15% bonds, and then 5% within property and commodities or something like that. But it's still a very aggressive portfolio with a little bit of diversification from including some different assets in there. as you get a little bit closer towards your kind of later life or like middle age, maybe you don't have as long left until you retire or want to stop working, then you probably want to be taking some of the risk out of your portfolio so you could reduce that equity exposure. And so this is more once you've kind of got your portfolio into a size where you want it, taking some risk off the table because you don't necessarily need that huge growth engine. Um, and you could then reduce the amount of equity exposure. So that could probably come down from 80 to 100% to more 50 to 60% uh, type exposure. And then traditionally, as you then head down to retirement, and sorry, that would be equities, and the rest would be made up through bonds. I've never seen portfolios where like where you get probably a higher allocation of like 10, 15% to commodities and others. Um, but then as you almost then come into your retirement, you want to secure and you don't want to risk your capital. You'll tend to see asset allocations being a lot more defensive. So you have a lot more bonds as a proportion to equity. So usually 30% um, equity, 70% bonds, something of that kind of split. There is kind of no right or wrong answer. Each of them comes with, the more risk you put into your portfolio, it's going to be, you'll get higher returns generally over the long term. The over the kind of you have more bonds, you have lower risk, you have lower return. So there's a sacrifice of risk and return. Um, I guess I don't know, Alex. I've been rambling on there. I don't know if you have any questions or thoughts or comments on any of that before. I was just going to then maybe talk about some of the practicalities of how this works if somebody's keen to do this for themselves.
Yeah, so I've just been basically scribbling notes down as you've been explaining each thing. So I think the from what I've kind of learned from you, my understanding is equities is where the growth is, and an equity in its simplest form is usually it's a stock in a company. And when people talk about, say, the stock market, people can be fearful of it, but actually, it's companies that you use every day. So if you have I don't know, an Apple smartphone, like an iPhone, Apple's on the stock market. If you drive a Volkswagen Golf, that's on the stock market, like the Volkswagen company. All of the big companies that you use every day will be likely listed on the stock market. I mean, I'm sitting here using a microphone and an HP laptop and some Microsoft software, all on the stock market. So the idea that I have and the way I kind of bought into it is I don't know enough about growing a company to make £10 be worth £20, say. But what I can do is buy small amounts of those companies and give some of that money to the best and brightest business minds in the world globally and let them do their thing because they want to make money. So, as if I'm on that kind of train as well, I'm going to make money at the same time. So, that's kind of my understanding of equities. And that's really where the growth comes from. That's where the returns will come from. The sacrifice here is that those prices go up and down a lot, so it can be a little bit like a roller coaster. Absolutely fine if you're in your 20s or 30s and you've got a long way to go until you need to take any of that money out into retirement or early retirement. Not so good if you want to retire at 59 or something, or 49 or 45 or whatever. And then I don't know, 2 or 3 months before that, you have a market correction. So it goes down 10%, which is normal. It's par for the course. That's no problem when you're 20, but problematic when you're 1 year out from retirement and your portfolio is down 10% and you've got less money available to you. So that's the idea of adding bonds to the mix because they help smooth the ride, help preserve some of the growth, the capital that you have, and then really give you a smoother amount of money in your pocket to spend every month.
Yeah, I think that's exactly right, and that's the perfect way to think of it. Is, like practically, you want your money working hard for you up to the point where you're going to start needing it and start to draw down on it. But yeah, you don't want at the end of you've worked hard and then as you said, you're 59, you're about to retire, and essentially not have any further income, you're living off the money that you've saved. You don't want to be 100% exposed to tech stocks because there's a real possibility that they then go down by 15, well, 10, 15, 20%, whatever it is. And the that could have the implications that you actually don't can't then retire, so you need to stay working for a little bit longer until the money recovers again. Sometimes it can take years and years for stock markets to recover, and you don't want to be retiring into that. So this is where asset allocation comes in, and it is just about reducing some of that risk and take some of your chips off the table to secure yourself, um, yeah, some of that income.
Yeah, I mean, yeah, it could be the difference between having £2,000 a month to spend and having £1,200 a month to spend in terms of withdrawing some of it out of your portfolio. And I got a lot of this. I mean, J.L. Collins puts it really well in
Yeah.
all of his work and his books. Um, it's about preserving the growth that you've had to give you an income when you most need it, so you can retire earlier. And if the market does better, I mean, I'm basing this on here, the Trinity study where you take
Yeah.
4% out per year. But if it doesn't do quite so well, you can take 3% or 2% and live a little bit leaner. When it's doing better, you can take 5, maybe 6% or more if you're happy with that. It's another kind of side point here is we would always suggest as well having perhaps a year or two's
Hmm.
worth of cash, probably 2, maybe three
Yeah.
years of cash, expenses on hand, because the last thing you want, like Alex, imagine we get to 45 and we're like, right, we're done, we're going to retire, and then boom, you have a 30% correction, like
Yeah.
COVID happens and everything goes down 35%, and then we're like, oh, we can't retire, we've already quit our jobs, maybe burnt a bridge or two. And you kind of don't want to be taking money out of the stock market during a phase when the prices are lower, because you'll have to sell more units to be able to spend the same amount of money. So having that buffer, that couple of years worth of cash, means you can use that for the short term whilst you wait for the markets to correct and go back up.
Absolutely. Yeah. That's a really good point. And that's, yeah, so true. And I think, yeah, as you approach retirement, yeah, having almost building up, it's like diverting cash away from your investments into just cash savings, then just builds you that bit of runway just to give you that. Because I think if you can get through, I read a book a few months ago about the details of the kind of the 4% rule and retirement and kind of withdrawal strategies. And it was looking at, because there's a thing they call like sequence of return risk. So if you were to retire, you then and then you suddenly go into 2008 where there was this huge financial crash. It took about 10 years for that to recover back to its pre kind of financial crash levels in all the stock markets. But it's like if you get the first few years of retirement and it's a kind of fairly average market, you're pretty much your whole retirement is then sorted. Whereas it can just having a few years one after each other where it's really rocky and turbulent and it goes down can scupper it. So it's quite those first few years are really important, the first 2 or 3 years. So yeah, having some cash and reserve and being flexible during that time is really is really vital.
Yeah, it almost ensures the path for the rest of your life, the rest of retirement. And it
Yeah,
could be the form of you have a couple of years cash on hand, or you reduce your hours from 5 days a week to two, or one, or you
is
have a
it?
part-time job just to supplement your income whilst the markets are down. And then when they go back up, which they will, we know that over time markets advance 75% of the time and they decline 25% of the time. So you'd have to be unfortunate for this to come about, but
Yeah,
to cover all bases, it's always better. You'll always be more financially healthy if you can weather like these storms.
absolutely. And I think this is where yeah, the asset allocation and paring down some of your equity exposure, you increase your bond exposure, you might have you'll have more cash, maybe some more of the kind of property or commodity investments creep in. So it just moves shifts the risk away a little bit. And the idea with the asset allocation is you almost want to be you want assets that zigzag in opposite directions. So you almost want when one is zigging, the other one is zagging. So it's kind of but they as a pool, they're growing together.
Mm.
Um,
That, sorry, just to interrupt, but
yeah,
a
yeah,
perfect example of that zig and zag is if we call, say, equities the zig part of it,
yeah,
those have gone down a little bit in value, and the gold price has gone up. So
yeah,
the equities would be the zig, and the gold would be the zag. They're related, they're linked together, because when equity prices fall and people lose a bit of money in the stock market, they tend to panic
yeah,
because they're humans. We're all human. We're emotional beings full of blood and flesh, etc. We're not robots. So what people then do is pull money out of the market, thinking, "Oh, I'm going to lose some money here. I'll put it somewhere safe, such as gold, which is actually a little bit useless. It's an inert metal. It's a good conductor, perhaps, used for some other stuff, but it's used as a store of value, but it will never grow exponentially in value. So if you have a gold bar in your drawer in your dining room and you paid, I don't know, however much money for it way back when, the the value in that gold is the value that humans give it. It can't create value in itself. So that's why I don't have any gold, I don't hold any or anything like that. I know a lot of people do, like they hold either physical bullion or they buy um, like shares in companies that do. A good proponent of that, and a book around all of these things as well, is called Own the World by Andrew Craig. He's written quite a lot of things around a broad asset allocation. So that would be a really good resource if you haven't read it to any of our listeners. I don't have a copy of that one I can post you, sadly. It was actually the first or second book I listened to on Audible.
yes. I've also listened to that on Audible. But yeah, he's a very good proponent, and asset allocation is a real um the whole idea of owning the world is about a broad asset allocation. Um, And I guess just before we move on to the next section, I just wanted to touch on like to practically how you can go about doing this if you're keen to introduce different asset classes to your portfolio. So there is you'll find if you have a workplace pension or if you have um you do your own pension but that you have what they call target retirement date funds. These are really common. And what that does, if you look at the kind of key facts sheet, that the fact sheet that comes with it, you will have essentially, as I described, a lot of equity exposure early on in your career. And it's then as you get closer to retirement, that reduces the amount of equity exposure, increases the amount of bonds. So that when you give it the date that you're going to retire, you'll then have got a much more balanced and less risky portfolio. Um, there's also, if you want, but instead of giving that to a fund manager to do and automatically doing it, you want to do it yourself. It's then about picking ETFs or index funds related to bonds. So as I think we've mentioned previously on this on the show, like Vanguard is very good broad-based market index funds. They have bond funds, as do other providers like iShares and I think BlackRock iShares they're called is another one, and that's different types of bonds. So you might want a corporate bond fund plus a government bond fund, and it's about um, allocating some of your money to those funds, and then each month you could do this by you could gradually build up an equity exposure. So if you're investing regularly every month, instead of directing it straight to your equity fund, you start directing some of it to your bond fund until it reaches your percentage allocation that you're interested in. Or alternatively, if you wanted to, you could just sell some of your equity fund and put it into the bond fund. And one thing which is then, if you're doing this yourself, one important element of asset allocation is called rebalancing. And what tends to happen is if you were to put is £200 or to £100, £50 in bonds, £50 in equities, and equities has a really good year and bonds stay fairly flat, your equities might be worth um, I'm going to struggle to do the math in my head, but it might be then worth 150 and your bonds might be worth 50. You've then suddenly swung so you've got 75% allocation to equities, 25% to bonds, whereas you wanted to have 50-50. So what you then have to do is sell some of your equities and invest it into bonds. And the reason this discipline is actually quite important is that it forces you to sell when assets have done well. So you kind of sell at the top or sell when they're performing well and buy underperforming assets. So it's that sell high, buy low automatically being um, kind of instilled into you without, and just by setting rules and say, I need X percent in X percent in equity, X percent in bonds, and I'm just going to, you know, robotically buy and sell in the correct proportions to get me to that balance. It stops you chasing trends. It stops you being scared of buying into something that might have come down. So it takes a bit of the behavior element out as well. So that's kind of the practical thing. I mean, I run a portfolio that's got several it's got an asset allocation, it's got several assets in there. Um, and because I invest monthly, before my kind of regular investment goes out, I calculate what my asset allocation is, and then I'll just invest into the assets which I need to either invest in to put up to hold up my proportion of asset allocation that I want. So that's the way I do it. I don't tend to get to a point where you sell and then rebuy. That's probably more relevant when you are retired and you're no longer putting significant amounts of money into your portfolio every month. That's where you do it. I know, Alex, you mentioned J.L. Collins, who's a great author. Simple Path to Wealth is a must read. He does it on his birthday, I think. So he does his asset allocation change once a year on his birthday. Um,
I think it's his wife's
his
birthday.
wife's birthday, maybe,
Yeah,
yeah.
because he'll
That was
never
it.
forget it.
Yes.
Um, yeah, no, that makes a lot of sense. So just as a counter thing to that, you do a lot more hands-on stuff than me. So I have a Vanguard fund. I'm not going to name it because it might come across as like advice or whatever. But the one I have is like it auto rebalances. So I pay a little bit higher of a fee for that. But I looked at the maths and I was like, actually, I'm happy
Mhm.
to pay a little bit extra for them to do that work for me, so I don't have to go and
Yeah.
kind of do that nitty gritty stuff as well. So that there are many options available.
Yeah. I for my self-invested pension, I do a similar thing. I just have it's a set fund which has a set asset allocation and it maintains that.
Yeah, yeah. So with a little bit of research, you can take a little bit of the manualness out of it, but just be
Yeah.
mindful of costs, of course, as we've discussed before. Yeah, Alex, is there anything else asset allocation wise that you'd like to that you think is worth kind of mentioning or repeating again? Or
I would just say it is a I mean I do it. I really enjoy it. It definitely isn't something that you have to do. And if you listen to what I say and thinking, oh my God, this guy's absolutely bonkers, I'm never going to do that. It's not like you have to. There's loads of options where you can get it automatically done. Doesn't need to be a headache with lots of offline reports or anything. It's just something I enjoy doing. It definitely isn't something that everybody has to. But yeah, I take a lot of joy and pleasure out of it.
yeah, so it's what works for some doesn't work for others, which is fine. The only other thing, Alex, I'd like kind of your opinion on is people talk a lot about kind of asset allocations, and there's a lot of mention on certain finance boards and Facebook groups, etc., that just to have 100% equities and let it run because you're young or whatever, you have a long time till you need the money. But I would think about the amount of say up and downness that you can tolerate in your portfolio. So, for example, if you have £10,000 invested and you go through COVID at that point and you lose 35% of that, you're then going to be looking at 6,500. How would you as a listener, how would you as an individual feel if you'd put in done the diligent work, you'd put in £10,000, it's grown a little bit as well, and then you're looking at a figure that's nearly half of what you think it should be, or perhaps what you saw the week or month before. Think about how that will make you feel. The one thing you don't want to do is sell at that point because you're what's called crystallizing losses. You've only lost money on paper until you sell and you make it permanent. So there's a chap called Andy Hart does a lot of behavioral investing work with his podcast and kind of company, etc. He's always said some really wise words that have really helped me that the stock market doesn't make mistakes, humans make mistakes. We are the fallible element in that. So be very mindful of it. And really, for me, the correct asset allocation is the one that keeps you invested, the one that keeps you like you stay the course for as long as possible. It's not a something that's too risky for you that you panic and then you sell and you end up selling at the lowest point and then you only gain confidence again when the market's gone back up and everything costs you twice as much and by your own actions you're back at zero, something like that. So do think about it. In my opinion, the best allocation is the one that you stick to.
I think that's really, yeah, solid words of wisdom. And I think it is one thing to read about stock markets going down. It's another thing when it's your money on the line and you see it go
Mm.
down. It is a, yeah, it's not pleasant.
You got to feel it.
You do, yeah, absolutely. And but the thing is not to panic. You know, you need that money 20 plus years from now. And will these companies be more valuable in 20 years than now?
Very likely.
Very more than
Yeah,
likely,
very
yeah, they
likely to
will
be.
be.
Yes.
And and so I think that's the always kind of bring yourself to that long-term view. It doesn't help that, or you'll be seeing a lot of it on social media. The mainstream news will be talking about stock market panic.
Mm.
People might be talking about it in the office, so you'll hear about it a lot. But it's really about, if anything, and the stock markets are going down, they're on sale, and it's all the more reason to keep putting money in because you're just buying more units or more shares of that particular company.
Yeah, absolutely. So I always try and avoid the noise, but recognize it for
Yeah,
what it is. So fortunately for me, which is a humongous stroke of luck, COVID happened about 3 months after I started investing. And I was talking to another chap who'd been investing a little bit of time, and he said something really smart to me. So he said, at this point, it's going to go down. You know it's going to go down. We know it's going to go back up because we know humans will engineer a solution to this pandemic, which we did, and markets did correct. So look at it every other day. Watch the money go down. Take notes on how you feel because if you can deal with a small correction at this point, where you lose, say, a couple of hundred, maybe £1,000, you can use the same principles to deal with it when the numbers are 10 times this, 20 times this, 100 times this. And I did that, and I noted how I felt, and I did feel panic, and I did feel a little bit of like, oh, I'd rather have the money here actually than watch it go down. But at that point, I didn't need the money. I left it well alone. It didn't impact my life, and I actually bought some more money. There's some more money. I bought some more of that index fund at that time because he said to me, Tom, he was like, if you've got any spare cash, now's the time to put it in. So I did a quick whip round of my account, see what I had available, and I put some more money in, and it happened to be very close to the bottom of that spike, and that's done incredible things. So cool heads prevail.
absolutely. And there's that thing of if often the time where you make your money is in like the bear markets, but even though it doesn't feel like it at the time,
Mm.
so I think it's definitely, yeah, good words of wisdom from you.
Yeah, I mean, a lot of that stuff that I've just mentioned came from like my friend Tom at the time, who I used to run the FIUK podcast with. He's now living in Australia for a bit. And the rest of it, the staying the course, the portfolio is just Morgan Housel. It's age old wisdom. He writes really, really well. All of his books are solid. And his blog on the Collaborative Fund website is also very, very good. Yeah, so don't make any rash decisions. If you think you're going to make a rash decision, email us and we'll talk you through it so you don't.
Yeah, absolutely right.
Yeah. Okay. Is that enough on asset allocation? Should we play a quick?
I think it is. If anybody's got any questions on it, yeah, please email in and we can cover them.
Yeah, absolutely, absolutely. It's good. We love that. Um, so a quick, reasonable or ridiculous. So this is one of my making for you, Alex, for your thoughts. So I have a dog at home. I buy her wet tins of food, like usually butchers or similar. Um, and I normally buy them in bulk. And when I say in bulk, I'll buy something like 3 boxes of 24 tins in a box. So that gives me what, 72 tins, something like that.
Yeah,
Yeah, so normally buy that, keep them. She has one or two a day, 1.5 to 2 a day, two max usually. And we're getting to the point where our stock was running out. I had like 10 tins left or something. So I was like, oh, actually, I'll need to buy some more. Put it on my to do list. And then I got a letter through the door from a well known pet company that says, we'll give you 25% off anything you buy. So I was like, well, this is ideal timing. So if you needed to buy some dog food and you had a 25% off voucher, and your dog eats probably somewhere maybe 40 to 50 tins a month, something like that. How many tins do you buy?
Oh, that's a good question. I would, because I assume the shelf life on tin dog food is quite long.
It's long, yeah.
I as long if you well, as long as you've got space to put it in, I'd get a good like 6 months worth. Just shove it in the garage or something. Then you don't have to worry about it. You've then got you've saved 25% on 6 months, so that's a quarter of 6 months, 1.5 months free of dog food.
Yeah.
It's something like that would be good, or even a year's worth. Your dog might get bored of the flavor, but uh, I would go quite big. That's a good discount actually.
Yeah,
Um,
I think so. So I played around with it a little bit, and the maximum discount you can get is £250. So you'd have to spend 1,000 at that point.
okay, yeah.
I'm not spending £1,000 for dog food in one go. Of course not. Maybe if I had 8 dogs to feed, but
You
not
need
with
a
one.
transit van to take all of it home, probably.
Yeah, exactly. And it was obviously free delivery. So I bought 216 tins, which is enough to last just over 7 months.
Perfect.
Yeah, and I worked it out that it would have cost £180, rounding up by 9 pence, and I paid 135.
Yeah,
So
brilliant. 50 quid
it's a
saving.
solid it's a solid saving.
Yeah,
And the delivery driver who dropped it off just was absolutely having a nightmare because they said loads of people have done the exact same thing and bought loads of really heavy tins of dog food.
yeah.
Um,
I,
but now I don't have to think about it for 7 more months.
exactly. I think it's yeah, super clever.
Mm. And luckily, fortunately, if you are kind of astute with your finances, I have that money available and I can take advantage of that discount.
Yeah,
It makes a big difference saving £50 on the order for the discount than it does buying one box and saving yourself five.
yeah, definitely.
So yeah, being financially astute, financially healthy means you can take advantage of big things. Yeah, as you go. Okay, so that's another agreement. We both think it's reasonable. So if you think it's ridiculous, and I bought far too many dog food tins, do let me know with your reasoning as well, and suggest how many tins or whatever you would have bought. Should I do a quick summary, or do you want to do it?
Yeah, I can happily do a summary. Um,
Cool, over to you.
yeah, so today we talked about asset allocation. So this is about the mix of all those different assets that you want to include in your portfolio. The going from an extreme, more aggressive stance to having more equities, so 80 to 100% exposure, right down to when you're going to start needing the money and you need that to stay still, moving down and having anywhere from 20 to 50% asset equity exposure. It's important if you want to do it yourself, make sure that you pick good funds that are diversified across multiple geographies and multiple industries, and also that you rebalance it every year, either every year or just rebalance it through or maintain your asset allocation through your monthly investments. If you don't want to do it yourself, not too bothered about it, there are plenty of funds that do it for you off the shelf. So they're also very good options. And I think that was my main things on asset allocation. I think it's really important, um, an important concept to be aware of. And yeah, please let us know if you've got any other questions on it or want us to go into detail on something. More than happy to on another episode.
Yeah, for sure. Or that was a great summary, by the way. Really quite good and succinct. If you have a totally different allocation and you're like 90% gold, 10% Bitcoin or whatever, and you think that is the perfect way
Yep.
of doing it, come on, talk to us, tell us about it, why you think it's worked, etc. So we're always keen to learn from other people as well. If you think anything different, but Alex, thank you for your time. That's been episode 57, and we're just over 39 minutes. So we'll wrap it unless you've got anything else.
No, that's it. Thanks, everybody.
None of what we discuss on the show is to be considered financial or health advice, and we recommend you always do your own research or consult an independent financial advisor or a doctor when making your financial or health decisions.